Hi again, it's just me, Steve. I want to talk to you now about the taxes you're going to face on the sale of your property, and specifically your single-family home that you occupy. I'm not a tax consultant, I'm not a CPA, but I studied the tax codes a lot, especially in the last 10 or 12 years. So I can give you some advice and some numbers. Of course, you got to verify them all with your own CPA and tax man, make sure they're correct. That's my disclaimer. Now, being Californians, we understand that California is going to get a piece of your action no matter what you do, your business, your home. So if you sell your home, you will have to pay some taxes. The federal government will also be involved in taxing you based on long-term capital gains. So what I want to just go through right now is what your tax situation very possibly will be. Years ago, when we were younger, if you sold your home, all you had to do was buy a home for $1 more and the taxes were waived on the sale of your property. Well, that's not true anymore. Today, each person in a couple gets $250,000 tax deduction against capital gains from everybody. So the couple, you get a $500,000 tax deduction off of your gain. Also, you get that on your basis of the property. So if you bought your home 25 years ago for $200,000 and you sell it today, you get your $200,000 plus the fine. So the first $700,000 you get is tax-free. The problem with having $1 million home is that that last $250,000 or $300,000 is taxable. Okay, so you're looking at a gain taxable of, let's say, $250,000 after sales costs and commissions. You're going to be spending 13% of that money to the state of California as our top tax rate. You'll probably get hit also at 3.8% tax from Obamacare because your income now has gone above $250,000. That's when the Obamacare tax kicks in. Your capital gain rate with the feds, if your total gross income is under $410,000 that year, you'll pay 15% to the Fed. If it's above that, you'll pay 20% of that money to the federal government. What it all means basically is that if you are a single person today and you get the one deduction, you'll pay a tax of about $177,000 on that $300,000 profit, $250,000 profit. If you're a couple, you only got to pay $100,000. So we're going to calculate that into our numbers when you look at the proceeds of the sale of your house, is how to pay your taxes. Now, I got 2 tips for you. This is, to me, it was a little known. I was kind of shocked when I learned this stuff by reading the IRS tax codes. But number 1 is if you've lost your spouse in the last couple of years, your deduction is now, you lost a $250,000 deduction because it's only allowed for the 2 spouses. But the IRS, in its benevolence, has said that if you sell the home within 24 months of your spouse's death, you can use that $250,000 deduction also as if they were still alive. So that means, and I got to agree with everybody that I've ever talked with, is in the first 12 months after a death, don't do anything. Just hang in and get squared away again and get through the mourning period, then decide what you want to do. But if you sell between 12 and 24 months, you can save yourself about $100,000 in taxes by utilizing that. The second tip is what they call stepped up basis. Again, if you lost a spouse, you can increase your deduction by increasing the value of your base in the home. In other words, if you bought the home for $200,000 and your spouse died and the home was worth $800,000, his half of the home was $400,000 that you inherited when he passed. That makes your basis now $600,000 along with your $250,000 exemption. That makes your tax-free money now $850,000. If you don't use a stepped-up basis, you're going to have about $250,000 in additional taxes. So those are tips for people. It's a lousy thing to talk about, but they're worth a lot of money to you. So we'll leave this tape on the site. Look at it whenever you want, and come back and visit us more often. See ya.